India has a very good outlook at the present time. From their low point, which was growth of about 5.5% a couple of years ago, we're predicting growth of about 7.3% for this fiscal year, rising a little bit to 7.5% next fiscal year. India has certainly benefited from low oil and energy prices as one of the world's largest oil importers, and that's raised the real incomes of all Indians. Also, they've done some positive policy actions in terms of introducing inflation targeting, better targeting subsidies, and also some land and labour market reforms. Of course, in these volatile times, no country is immune from both internal and external shocks. The main internal risk for a country like India comes from weak corporate and bank balance sheets. There's been a big increase in non-performing loans at the present time due to the previous shortfalls in investment. So that's a concern, but we think it's a moderate concern and one that they'll be able to manage with better regulation and supervision from the central bank. On the external side, of course, we've seen a big uptick in global financial volatility in recent times. India will not be immune from that, but they're in the best placed position among emerging economies to withstand that. And we think, given their much smaller current account deficit and healthy FDI flows, that they'll be able to ride their way through this. The number one policy that we would look to have them implement is to introduce the goods and services tax, which will not so much be a revenue raiser, but it will lower trade barriers across the 29 states of India and give a fillip to growth as well. We would also like to see them lower land and labour market regulations, and also finally tackle agricultural reforms, both in the storage, handling and distribution of food, which will also help keep food inflation down, which is obviously a big issue in a country like India, where food is 60% of the consumption basket.